Welcome back to the channel. Today, we're diving into the world's most powerful currency, the US dollar. As we move through the first month of 2026, the greenback is having a bit of an identity crisis. On one hand, you have experts calling for a massive depreciation, citing a mountain of national debt and a Federal Reserve that's finally pivoting toward rate cuts. On the other hand, the U.S. economy keeps putting up numbers that defy gravity, strong labor markets and resilient GDP growth that are triggering sudden, sharp rallies. So, is the dollar losing its crown, or is this just a temporary dip before a mid-year comeback? Today, we're breaking down the three forces pulling the dollar in opposite directions and why the second half of 2026 might look very different from the first. Let's start with why the dollar has been under the gun. Throughout 2025 and into early 2026, the US dollar index, or the DXY, has faced persistent downward pressure. Why? It comes down to three things: rates, debt, and uncertainty. First, the Federal Reserve. After the aggressive hiking cycle of previous years, the consensus for 2026 is a downward trend in interest rates. When the Fed cuts rates, the yield, or the return on dollar-denominated assets like Treasury bonds, drops. This makes the dollar less attractive to international investors compared to other currencies. Second, we have the fiscal elephant in the room, U.S. debt. Market participants are increasingly wary of the deficit. With political battles over the debt limit and massive government spending projects like the One Big Beautiful Bill Act, there's a growing fear that the dollar's long-term value is being eroded. And finally, policy uncertainty. With a new administration in Washington and a potential change in Fed leadership, as Jerome Powell's term concludes in May, the markets hate the unknown. We've even seen central banks globally, from Serbia to the BRICS nations, increasing their gold reserves as a hedge against a weakening dollar. But wait, don't count the dollar out just yet. Every time the bears think they've won, a new piece of economic data hits the wires and the dollar surges. This is what makes the 2026 forecast so complicated. Despite the talk of a slowdown, the U.S. labor market remains incredibly stubborn. While job growth slowed to a near halt in late 2025, unemployment has stayed remarkably low, sitting around 4.4%. This tightness means the Fed can't just slash rates overnight without risking a second wave of inflation. Furthermore, compared to the rest of the world, the U.S. is still the cleanest shirt in the dirty laundry basket. Europe is flirting with stagnation, and China's recovery has been uneven. When the global economy looks shaky, investors run back to the dollar as a safe haven. We saw this just weeks ago. Even as the dollar faced its biggest drop in years, it started 2026 with a positive bounce, because frankly, there isn't a viable alternative to the dollar's scale yet. So where do we go from here? Most analysts are calling 2026 a tale of two halves. In the first half of the year, expect the V-shaped path to start with a dip. We could see the dollar weaken further. Some analysts predict the DXY dropping from 98 down toward 94 as the market prices in those initial Fed rate cuts and processes the political transition at the Fed. However, keep your eyes on mid-2026. This is where the rebound is expected to take shape. By June or July, the lagged effect of government spending and potential trade tariffs are expected to trickle through the economy. If these policies spark a bit of inflation, or if the U.S. GDP continues to outperform the Eurozone, the Fed might be forced to pause their rate cuts or even signal a higher-for-longer stance again. By the time we hit the third quarter of 2026, the dollar could be back on top, fueled by a combination of high interest rate differentials and its status as the world's primary reserve currency. To wrap it up, the U.S. dollar is in a tug-of-war. The pull comes from high debt and lower rates, while the push comes from a resilient domestic economy in global instability. For you, as an investor or a viewer, this means one thing: volatility. Don't expect a straight line down. Instead, look for temporary rallies followed by uncertainty-driven dips. The real test for the dollar will be how the new Fed chair handles the 2% inflation target in the face of massive government spending. What do you think? Is the dollar's decline inevitable, or is the king dollar just catching its breath before another massive run? Let me know in the comments below. If you found this breakdown helpful, hit that like button and subscribe for more deep dives into the global markets.